Hi everyone, welcome back after a volatile week in the markets. I hope you enjoyed all previous episodes and found them useful. A brief note that these videos highlight only a selection of the analysis published on Behave and X, with links available in the description below. In this episode I'll be covering whether the AI bubble is at risk of bursting. This comes as AI spending is approaching dot-com bubble levels, exceeding them on some metrics at a time when corporate willingness to pay for AI is starting to crack. I will also cover this week's key market developments, including the SpaceX IPO. Let's kick things off. Hyperscalers are on track to allocate 98% of their entire operating cash flow to capital expenditures in 2026. This is according to Goldman Sachs data. This group includes Alphabet, Amazon, Meta and Microsoft, the four largest cloud and AI infrastructure spenders in the world. This compares to 95% for the broader S&P 500 tech, media and telecom sector at the 2000 dot-com bubble peak. Looking ahead, big tech capex is expected to reach $920 billion in 2027. Goldman's upside scenario is even projecting as much as $1.4 trillion, representing growth of up to 89% from 2026 average projection levels of $657 billion. AI investments is also on track to dwarf every capital expenditure cycle in modern history. AI software capex is forecast to reach 9% of global GDP, a level never seen before. By comparison, the railroad boom of the 1880s peaked at 6% of GDP, the largest prior capex cycle on record, while the car manufacturing boom of the 1920s peaked at 3% of GDP. The current AI data center build-out alone already accounts for 2.5% of GDP, with software at 3%, putting the combined total above every prior tech cycle, including the internet and semiconductor boom. However, the scale of spending is increasingly running ahead of the execution. More than 60% of US data center capacity planned for completion in 2027 is not yet under construction, and another 7% is already delayed, according to a JP Morgan analysis. Of the 35 gigawatts of data center capacity with unknown completion dates, only a fraction is actually under construction, with the vast majority remaining at the announcement stage. This comes as supply chain backlogs, permitting fights, power grid connection delays, and shortages of gas turbines and electrical transformers are all contributing to a widening gap between announced ambitions and actual progress. Despite this, Microsoft, Alphabet, Meta and Amazon collectively spent $410 billion on capex last year and are expected to spend more than $670 billion in 2026, while Alphabet alone recently raised $80 billion in new equity to fund AI-related investment, prompting market concern over the true scale of capital requirements. This is all unfolding when corporate willingness to pay for AI is starting to crack. The LLM token expenditure index has fallen to $1.8 per million tokens, reflecting declining marginal willingness to pay for AI output. Tokens are the units of text processed by AI models, meaning the index captures how much companies are willing to spend per unit of AI usage over time. This comes as corporate AI costs face increasing scrutiny, with OpenAI CEO Sam Altman acknowledging that expenses have become a huge issue for customers and reportedly considering sharp price cuts to compete with Anthropic. A potential price war between OpenAI and Anthropic could compress margins and slow the path to profitability for both firms, while also accelerating the commoditization of AI models. As pricing declines, returns on the massive infrastructure build-out risk compressing further, raising questions over whether incremental capex can still generate sufficient economic return. Businesses are increasingly sensitive to AI spending as early enthusiasm gives way to tighter budget controls and more selective model usage. When AI pricing starts to commoditize, the bull case for sustained premium valuations becomes harder to defend. Put simply, if AI companies cannot generate enough revenue to justify their infrastructure costs, their stock prices will fall as investors reprice the earnings expectations that currently support near trillion US dollar valuations. In summary, the AI data center buildout is generating more headlines than cash flow and capacity, and the question is whether returns will ever match the scale of investment being deployed. Switching gears to the market performance, the S&P 500 has finished in 10 of the last 11 weeks. This week was supported by a short squeeze on Thursday and Friday, driven by yet another wave of optimism around a US-Iran peace deal that markets have now priced in and out more than 38 times since the conflict began. As a result, WTI crude oil prices posted their third weekly decline in 4 weeks. At the same time, Fed rate hike expectations were pushed into next year as oil prices declines eased inflation concerns. Notably, gold and silver ended the week lower but recovered some losses on Thursday and Friday. You can find more about gold and silver in my recent posts. Meanwhile, SpaceX first trading day exceeded many investors' expectations. This comes as mom and pop investors bought a net $93.8 million of SpaceX shares on Friday, the largest single-day retail purchase at any IPO on record. This is according to Vanda Research data. The firm's shares also accounted for 4% of all single stock retail turnover on Friday, with net purchases running at more than 3.5 times the pace of Nvidia, the next most purchased stock in the US stock market. SpaceX closed its debut trading session at a market value of $2.2 trillion, the sixth largest among publicly traded US companies, behind Amazon at $2.5 trillion and ahead of Broadcom at $1.8 trillion. At this valuation, SpaceX is now $700 billion larger than Tesla and more than twice the size of Berkshire Hathaway. Retail investors showed up for SpaceX in a way not seen at any IPO in recent history. As a result, SpaceX now trades at a price-to-sales ratio of 119 times, way above the valuations that defined the peak of the 2000 dot-com bubble. By comparison, Yahoo traded at 118 times sales at the 2000 dot-com peak, while Cisco traded at 39 times and Qualcomm at 55 times before all three subsequently collapsed. Among the companies shown in this comparison, Palantir at 63 times sales today is the closest to the dot-com era peak valuations. The question investors must ask is whether SpaceX debut at 119 times sales marks the peak of the AI bubble or is simply its next phase. That's it for this episode. More insights on global market developments are available in the most recent market recap on Beehive. I highly recommend subscribing and carefully reading through it as already hundreds of investors do. Let me give you a quick walkthrough of what you can find there. When you open the Beehive website, you can browse the most recently published articles which are released every day. On Sundays, there is a market recap which is partially available to free subscribers, but the bulk of the content is available only to premium members. Similarly, every month I publish my portfolio performance review where you can see how the portfolio has performed year to date, with comparisons to 2025 and 2024 also available. If you want more insight into how I structure my investment portfolio, you can open the investment portfolio tab at the top of the page. Everything is described there, including how the portfolio performed during the April 2025 sell-off and the most recent updates. Those who are subscribed as founding members and have access to this portfolio have been very happy with both the results and the thinking behind them. I think that's all for today. See you next week. Remember that this video is for informational and educational purposes only, and should not be considered financial advice or recommendation to buy or sell any securities. All views are my own